Hello, everyone. I hope the audio is clear. Since this is our first day of revision, we're going to start off with a recap of income tax. So the first aspect of income tax is the tax residency status of is a tax residency status of an individual. So we're going to check whether an individual is a UK resident or not. Now, in order to do the test, you have to complete, in order to check that, you have to complete 3 tests. Now, normally, this particular section will be tested in your section A as an MCQ, or it can be clubbed with your section C income tax question. So, when you do a tax residency status check for an individual, you should always make sure that you follow the rule or the order. First you'll start off with an automatic overseas test. When you do an automatic overseas test, if any one of the condition is satisfied, you are a non-resident. You're automatically a non-resident UK during that tax year. If you fail the test, you proceed to the next one, which is an automatic UK test. And if you pass any of the conditions in that test, you are automatically treated as a UK resident. And finally, you have the sufficient ties test. So if you fail the automatic UK test, we proceed to the sufficient ties test. And in the sufficient ties test, if you pass it, you are a UK resident. And if you fail, you are a non-resident during that tax year. Now, as an examination point of view, it is very important for you to by heart the conditions in each of the tests. So, in automatic overseas test, as the word suggests, automatically treated as a non-resident if any one of the condition is satisfied. Not all of them, any one of the condition. So, you have to by heart the conditions. They spent less than 16 days in the UK during the tax year and was UK resident for one or more of the previous 3 tax years. So, during the current tax year, whichever be in the question, they should spend less than 16 days and was a resident for one or more of the previous 3 tax years. Or they spent less than 46 days during the current tax year and were not resident during the previous 3 tax years. Or they should work full-time overseas throughout that tax year and spend less than 91 days in the UK during the tax year. Both the conditions have to be satisfied. They should do a full-time work overseas and also they should spend less than 91 days in the UK during the tax year. So if any one of the condition is satisfied, they are automatically treated as a non-resident in UK for that particular tax year. Proceeding to the next one, which is an automatic UK test. So if you fail the first one, you move to the second one. And if any one of the condition is satisfied, you're automatically treated as a UK resident. So spend 183 days or more in the UK during that tax year, or has a home in the UK and no other homes overseas. It doesn't matter if you have a rented home also, have a home in UK, no other home overseas. Works full-time in the UK during that tax year. When I say a full-time job, it does not mean you have to work for 365 days in UK. Whatever work you're pursuing, that should be a full-time job. Meaning, you cannot be doing a part-time job and that automatically means that you fail the condition. Then finally, if you fail, then you move to sufficient ties test. So I always tell you a rule of doing sufficient ties test. First, you take the table. If you have a situation where you have to use a sufficient ties test, go to the table. From the question, identify the number of days during the tax year they stayed. So the number of days they stayed in UK during the tax year which is asked you in the question. Also, you need to identify whether they were previously resident or previously non-resident. So the first thing is to determine the number of days they stayed in the UK during the current tax year. And the second one is to check whether they are resident or not resident previously. On the basis of that, you have to determine the number of ties required. And you have to check whether they meet the sufficient number of ties. So having a close family member in UK, which can be spouse, civil partner, or a minor child. Having accommodation in the UK in which the individual spends at least one night. So one night is equal to 1 day. So having one accommodation can be a rented accommodation as well. Doing substantive work in the UK, there is an indication. Substantive work means 40 days work at least 3 hours a day. Being in the UK for more than 90 days during either of the 2 previous tax years. So either in the previous 2 tax years you have spent less than 90 days, or in any one of the tax years you have spent less than 90 days. Spending more time in the UK, which is basically half or more of the tax year. Spending more time in UK than any other country. Also, you should also be previously resident in UK as well. So you have to check whether you meet any of the ties, any of the following ties. Hello, Ishant. What will be the duration of this revision? Are you asking me on a daily basis? So we'll be having around 2.5 hours. And then we'll be having the revision for the next 5 days. That is still Saturday. I hope that was useful. So that was about UK residency. I'm moving to the first portion, which is basic computation of taxable income and income tax liability. This stands as a base chapter for rest of the chapters in income tax. So first we are going to do income tax revision. Income tax, direct tax, it is levied on the taxable income during a tax year. It is a revenue tax because you have capital tax and revenue tax. Income tax is a revenue tax. And there are 2 types of incomes. There is a taxable income and a non-taxable income. Non-taxable incomes are the exempt incomes. I'm going to directly go through that area. You have to by heart the list of exempt income. Okay, please keep that in mind. You have to by heart which all comes under the exempt income. So you have income from ISA, income from saving certificates and betting and gaming wins or premium bond wins. And certain cases, child benefit is also exempt. So coming to ISA, income you receive from ISA is exempt under all circumstances. So there is one thing which was tested for a main examination. There is a limit on the amount you can invest to ISA per tax year. The amount of investment into ISA per tax year. So keep that in mind. It is 20,000 for the current tax year. So the maximum amount you can invest into ISA for 23-24 tax year is 20,000. And any income that you receive from that 20,000 investment is an exempt income. So you might receive income or interest or dividend. Both of them are exempt. Now this 20,000 investment can be made in the form of cash or in the form of shares or a combination of both. So there was a question in your examination where they said an individual had invested 12,000 as cash into ISA. So what is the remaining limit of investment as shares? So obviously it is 20,000 minus 12,000, which is 8,000. So keep in mind per tax year 20,000 limit into investment for ISA, out of which it can be a combination of cash and shares or cash individually or shares individually. Savings certificates. Now this is a matter of confusion for many students because NSA issued savings certificate incomes are exempt because NSI interests are taxable. In certain cases, national savings and investment interest are taxable. But if the savings certificates, the interest issued or the profit received from the savings certificates issued by the NSA is exempt. So just remember to segregate that. If you see the word savings certificates, just keep in mind that income from savings certificate is exempt. Then premium bond wins, betting wins, gaming wins, lottery wins are all exempt. And in certain cases, child benefit is also exempt. I hope you remember. If your adjusted income of the recipient of the child benefit or their partner or both of them, if the adjusted net income of both the recipient and their partner is less than 50,000, in that circumstances, child benefit is an exempt income for that family. Now, having said that, let's move to the list of taxable incomes. Taxable incomes can be further classified into non-savings, savings, and yes, Ishant, the classes will be uploaded as if it will be available in YouTube. So taxable income includes non-savings income, savings income, and dividend income. So non-savings income, income from employment, property letting, trading, professional fees, and pension income. Savings income is always important to learn the list of savings income. So you have bank interest, interest received from bank, deposits, from building society deposits, from loan notes of both listed and non-listed companies, and listen, interest from NSI. If you can see here, interest from NSI. But if it is interest or profit from NSI savings certificates, that is exempt. If it is interest from normal NSI accounts, it is a taxable savings income. Remember, if you fail to properly classify, the rate of tax will be different. For say non-savings and non-savings income, the rate of tax is same. But for dividend income, the rate of tax is different. So make sure. But savings income is eligible for nil rate. So classification of your income is very relevant. You have to properly classify as non-savings, savings, or dividend, or exempt. If it is exempt, there is no tax. If it is if it is taxable, it can either be non-savings, savings, or dividend. And keep in mind, non-savings, the rate of tax is 20, 40, and 45. Savings also it is 20, 40, and 45. For dividend income, the rate of tax is different. Savings income and dividend incomes are eligible for nil rate as well. Okay, and don't forget, interest received from government securities, gilted securities, and bonds are also exempt income as well. So learn the list. So I told you to learn two things here. One is I want you to learn the list of savings income. Okay, these all items are taxable savings income. I also want you to learn the list of tax exempt income or non-taxable income as well. I hope that is clear. And dividend is the dividend received from owning shares in a company during a tax year. So the basic taxable income computation, you have to properly segregate. And here onwards, since we have finished with the entire topic, just keep in mind, you always try to write tax adjusted trading profit first. And if you have any trade loss carry forward, you adjust that initially. Then you can list out your employment income, property income, pension income, bank interest, received building society interest, and dividend income as well under the respective heading, and make sure you give proper headings as well. The sum of non-saving, savings, and dividend income is what we call as total or general income, from which we have to deduct qualifying interest payment. Qualifying interest payments are interest payments on certain type of loans. So what are the different type of loans on which the interest payment is deductible? So interest on loan to buy plant and machinery for partnership use, interest on loan to buy plant and machinery for employment use, interest on loan to buy shares in an employee controlled company, interest on loan to buy shares in partnership and cooperative society. So for these 5 type of loans, any interest that you pay during the tax year is a deductible interest from your general income. And also you can make your current year trade loss relief and your carryback trade loss relief as well. And finally, you will get your net income. From your net income, you can make a deduction of personal allowance, which is 12,570. But you're not always eligible for 12,570. Keep that in mind, because if your adjusted net income is above 1 lakh but below 125, 140, you'll have a reduced personal allowance. And if your adjusted net income is above 125, 140, your personal allowance becomes 0. That's very important aspect. Now, students who are doing section C, I want to indicate if your personal allowance is 0, don't simply write here 0. In this column, in this cell, you have to write since ANI above 125, 140 and indicate 0. So that will make sure you get that 1 mark there. So you have to write personal allowance and in bracket you have to write since ANI above 125, 140, and in the amount column, you have to indicate 0. So don't simply put 0, give the reason for that in the cell as well. Finally, you will get your taxable, non-saving, savings, dividend income, and your total taxable income. This is your total taxable income. This is your total taxable income. Now, on the basis of this total taxable income, we decide on the category of taxpayer this person is. So as you are aware of the fact, there are 3 categories of taxpayer. There is a basic taxpayer, there is a higher rate taxpayer, and an additional rate taxpayer. So coming to the first one, which is, okay. So before that, personal allowance, I've already discussed. If your adjusted net income is less than or equal to 100,000, your personal allowance, you're eligible for your entire personal allowance. If your adjusted net income is above 1 lakh but below 125, 140, that is from 1 lakh 1 to 125, 139, your personal allowance will be reduced. I hope the computation was clear for you, which is personal allowance minus 50% into NI minus 100,000. If it is a section A calculation, because in section A, your steps does not matter. You just need to get the correct answer. But if you're doing the same calculation in section C, you have to show it as a separate working note with proper steps. So personal allowance, you'll write down the personal allowance. You'll take your adjusted net income from the limit of 1 lakh, the excess, and deduction of 50% of the excess, you will get your restricted personal allowance. The same step, but I have just elaborated it with some additional step. That's all. And the marginal rate of tax is 60%. Just keep in mind, if your net income is between 1 lakh and 125, 140, you will have a marginal rate of tax of 60%. And if your adjusted net income is greater than or equal to 125, 140, your personal allowance is 0. Now that brings us to the question, what is adjusted net income? I hope you're aware of the fact adjusted net income means your total net income minus gross amount of PPC and gross amount of gifted donation. Just keep in mind, by default, the amount of PPC and gifted donation given in the question is net. You have to convert that into gross. So gross amount is equal to net divided by 80 into 100. Because 80% is net, you have to convert that into 100%. So net amount divided by 80 into 100. So gifted donation and personal pension contribution amounts will be given in the question. Just make sure whether they've given you the net amount or the gross amount. If nothing is mentioned, it is net amount, convert to gross amount. If already gross amount is given to you, directly take that. Then this is the table. This will be provided in the examination, but in a different format. But the same contents will be available in the tax, rates, and allowances table towards the left-hand side of your CB practice platform. So, starting off with your basic, the 3 categories of taxpayers: basic rate taxpayer, higher rate taxpayer, additional rate taxpayer. The category is decided on the basis of total taxable income. So if your total taxable income is between £1 to 37,700, you are a basic rate taxpayer where you will be paying a tax of 20% and 20 on savings and non-savings income, 8.75% on dividend income. Now, if your total taxable income is between 37,701 and 125, 140, you're a higher rate taxpayer and you have to pay a tax of 40 or 33.75%. And students who are doing receipt for tax, this is your first change in the tax paper for Finance Act 2023. This limit has changed. Normally, it was from 37,701 to 150,000. Now it is from 37,701 to 125, 140, including 125, 140. So your higher bandwidth has changed. So your higher bandwidth was previously from 37,701 to 125, 140. Now it is 87,440. So the bandwidth is 87,440. And any taxable income above that, they are an additional rate taxpayer, where your non-savings income will be taxed at 45%, savings at 45%, dividend at 39.35%. Keep in mind, we are having a proportional taxation system, which means always the first 37,700 will be taxed at basic rate. That means, let's say you are a additional rate taxpayer. Okay, still from £1 to 37,700 of your taxable income will be taxed at the basic rate. Then from 37,701 to 125, 140, it will be taxed at higher rate, and anything above that will be taxed at additional rate. Okay. So students who are doing receipt, please keep in mind, this is your number 1 change in the syllabus. Your higher bandwidth has changed. Now the next change is students who are doing receipt. The next change is for savings income nil rate, it is still the same. If you are a basic rate taxpayer, the first 1,000 of your savings income is taxed at 0%. If you are a higher rate taxpayer, the first 500 will be taxed at 0%. And if an additional rate taxpayer, you do not have any nil rate. Second one is savings income starting rate. What is the condition for savings income starting rate? This is a hidden adjustment in your examination. So make sure you're very, very thorough with that. If your taxable non-savings income is less than 5,000, then you get an additional savings income starting rate, which is the amount of 5,000 minus non-savings income. That much amount in your savings income will be taxed at 0%. Along with that, you are eligible for the normal nil rate of savings income, and the remaining amount will be taxed at whatever rate taxpayer you belong to. Okay, so keep in mind, if there is a tax rate of 0% for taxable savings income up to 5,000, this is not a savings income starting rate, but the condition is that your taxable non-savings income should be less than 5,000. Then you have dividend income. Next change, remember, students who are doing resit, your second change is your dividend income nil rate has changed from 2,000 to 1,000. So the first 1,000 will be taxed at 0% from here onwards for this tax year. 2,000 eligible alla. ആദ്യത്തെ 1,000 മാത്രമേ nil rate, dividend income nil rate eligible ആയിട്ട് വരുന്നുള്ളൂ. Then, if the question asks you specifically calculate your income tax payable, keep in mind it is your total income tax liability minus payee. So pay amount will be given in the question, pay as you earn. So this amount was already deducted from your salary during the tax year. The excess amount of liability is what you have to pay to your tax authority, which is your total income tax payable. Extension of band, which is very important. If in the question, I've always told you in the class, there are two situations where you have to do a band extension. Number one, in the question, there should be a PPC or a gifted donation, personal pension contribution or a gifted donation. Number two, in the question, they should say compute income tax liability or compute income tax payable. If both conditions are satisfied, you will have to do a band extension. Number one, what is the number one condition for band extension? In the question, they will have to mention. So in the question, they will have to mention number one, they'll have to mention there is a PPC or a gifted donation during the tax year. Number two, the question requirement should be to calculate. Requirement is to calculate income tax liability or income tax payable. Then coming to child benefit charge, normally child benefit is exempt, but that is where the adjusted net income of both the recipient and their partner is less than 50,000. But if either one of them has their adjusted net income between 50 and 60, there will be a partial charge. And if it is above, if both of them or either one of them has their adjusted net income above 60,000, then the full amount they received as child benefit is given back as tax. So they receive 100, they'll give back the entire 100 as tax. So you have to add the child benefit charge to your income tax liability. So child benefit charge is 1% into the child benefit received into ANI minus 50,000 divided by 100. So I've given the situations here. If ANI is less than or equal to 50,000 of if recipient and the partner, if the adjusted net income of both the recipient and their partner is less than or equal to 50,000, it is an exempt income. If either one of them has their adjusted net income between 50,001 and 59,999, there is a partial charge, and this is how you do the partial charge computation. And if it is above 60,000 for either one of them, the entire amount they received, they will have to give it back as tax. And transferable personal allowance, I gave you the conditions for transferable personal allowance. So the unused personal allowance of one of the spouse can be transferred to the other spouse during a tax year. First condition is both of them should be a basic rate taxpayer. Number two, they should make a joint election or a declaration to transfer the unused personal allowance. Number three, Whoever is planning to transfer should have a minimum of 1260 unused personal allowance. Then only they can transfer it to their spouse. So how does the transfer happen? Do they directly give 1260 to the spouse? No. The spouse, whoever is ready to receive the personal allowance, they will do their income tax liability. And from their income tax liability, 1260 into 20% will be deducted. Okay. So if in this, whoever is planning to, both of them has to be basic rate taxpayer, they have to make a joint election. But whoever is planning to make the transfer should have 1260 unused personal allowance. And whoever is planning to receive, they should do their normal income tax liability. And from that income tax liability, they have to make a deduction of 1260 into 20%. And in the name of marriage allowance or transferable personal allowance. So in the class, I had discussed and I gave you a couple of formats, and I hope that this will be useful for students who are attending the revision as well. So when you do a computation of income tax liability, what are the maximum adjustments? Computation of income tax liability. So what are the maximum adjustments that you will have to suffer? So number one is obviously the tax liability for, you should always start with the tax liability for non-savings income. You should add the tax liability for savings income, and keep in mind savings income has nil rates. So make sure you apply that, and you add the tax liability for dividend income, and again this has nil rates. You get your total tax liability. From this total tax liability, you will have to add child benefit charge if there is a child benefit charge, partial or full child benefit charge. You will have to deduct if there is a chance of marriage allowance, which is very rare. Child benefit charge and marriage benefit allowance both don't come together in a single question. And then there is an interest relief on mortgage loan, which we'll discuss in property income. And you have to add additional charge on pension contribution, which I'll tell you during the pension chapter revision. Finally, this is your total tax liability. And from this, you will have to deduct payee. And once you deduct payee, you will get your tax payable. Okay, so don't worry, you will not be given a question where you'll have to apply all these knowledge. Most probably the question will have either a non-savings income tax liability or a savings income tax liability. There will be either a child benefit computation or a marriage allowance computation. Child benefit charge is added to the tax liability. Marriage allowance is a fixed figure. It is 1260 into 20%. This will be deducted from the income tax liability. Interest relief on mortgage loan for property income, I'll tell you during chapter 6 revision. Additional charge on pension contribution. From this, you have to make a deduction for payee. This figure will be directly given in the question. You don't have to do any sort of calculation. That is your income tax payable. I hope that was useful. Okay, so coming back to jointly held property, sometimes spouse or civil partners will jointly hold properties from which they will receive income. Keep in mind the incomes are split equally. Normally the incomes, it can be rental income or interest income, it is split equally. But if they make a joint election to split the income on the basis of their ownership. So if they make a declaration, you will have to split the income on the basis of their ownership. If no declaration is made, the income is split equally between both the spouses, and then their respective income tax liability is computed. There is a concept of accrued interest. This is to prevent bond washing. So When do you do a computation of accrued interest? So I've given in the question, calculate the interest income accessible from gilt-edged security or government security during a particular tax year. So the question requirement will be to calculate the interest income from gilted securities during a particular tax year. You will have to apply the rule of accrued interest. This is a very important calculation. Make sure you study or do at least 2 questions which you have in your kit. So I'll just show you the number of questions. For students who are just doing self-study, make sure you do question number 13 from Kaplan. You do question number 15 from Kaplan, and from your BPP 13 and 15 from Kaplan, and from your BPP you ought to do question number 53 Marriott. So these 3 questions test the knowledge of computing accrued interest income. So this is to prevent bond washing. So you will have to calculate what is the amount of interest income which is taxable for a particular individual during a tax year. So the question will say they purchased the gilt-edged security during the tax year, and they sold the gilt-edged security before the end of the tax year. So you just have to see for how many months they held the gilt-edged security, and you will have to calculate the proportionate interest on that. So question number 13 and 15 from Kaplan Kit and question number 53 from BPP. They're pretty good explanations for accrued interest concept. Okay, so that is basically the first chapter. I'm going to quickly go through chapter 3. If somebody wants to take a screenshot of this, just keep in mind this is your basic employment income computation. So normally when you do an employment income computation, you have to start with salary or wages and make sure you take an annual value for it. So let's say they have only worked for a couple of months during the tax year, then you have to take that many months into the monthly salary. If already annual value is given, please don't convert. You can add bonus, and when you take the bonus, just keep in mind the rules of earnings. So the rules of earnings is pretty simple. If you are an employee, you need to check to which tax year you have to show your bonus income. So the rule is it is earlier of the payment date and the entitlement date. So in the question, you have to see the payment date and the entitlement date for an employee, and you have to check the earlier date. You need to check on which tax year this earlier date appears, and for that tax year, that bonus will be taxable. So let's say the earlier date falls in 22-23 tax year. So that bonus ought to be taxed at 22-23 tax year. Okay, so you have to take the payment date and the entitlement date. Do not consider any other dates from your question. Payment date, entitlement date. Earlier date select ചെയ്യുക. ആ earlier date ഏത് ടാക്സ് ഇയറിൽ വരുന്നു എന്ന് ചെക്ക് ചെയ്യുക. എന്നിട്ട് ആ ടാക്സ് ഇയറിൽ വേണം ആ ബോണസ് ഇൻകത്തിന് ടാക്സ് കൊടുക്കാൻ. നിങ്ങൾ ഒരു ഡയറക്ടർ ആണെങ്കിൽ, which will be very clearly said in the question, you have to take 5 dates. ആ 5 ഡേറ്റ്സിൽ 4 ഡേറ്റ്സ് വേണം കമ്പാരിസൺ യൂസ് ചെയ്യാൻ. എന്നിട്ട് അതിലെ earlier date നോക്കണം. And the earlier date, if you have to check to which tax year that falls, and in that tax year you will have to calculate your you'll have to show the bonus as your assessable income. So it is date of receipt, that is basically the payment date itself, the date of entitlement, the time when the amount is credited in the company's records, the end of the SOPL period, or the determination period or the voting period. Now keep in mind, out of these two, you can only select one. So if you want to select the SOPL end date, the determination should happen before that. If the determination happen after the SOPL date, you have to take the determination date for comparison. So out of the 5 dates, only 4 dates can be used for comparison. So out of 4 and 5, the decision is if SOPL എടുക്കണമെന്നുണ്ടെങ്കിൽ അതിന് മുമ്പ് determination. Determination date എടുക്കണമെന്നുണ്ടെങ്കിൽ SOPL end date ശേഷം വേണം determination നടക്കാൻ. So determination is basically the voting date. Okay, so coming back to the main format. gratuities can be added, excess of mileage allowance. Employee used his own car for business or employment purpose. Keep in mind, employee used his own car for business purposes. He will get a reimbursement from the company. There is a statutory deduction from that reimbursement. First 10,000 miles will be taxed, deduct 45 pence, and the remaining miles are 25 pence. So in this example, if you notice, employee uses his her or her own car or van for employment purposes, receive reimbursement from the employer. Keep in mind, for the first 10,000 miles, it is 45 pence. And for the remaining 10,000 for the remaining miles, it is 25 pence. Just make sure that all the miles traveled are for business purpose. Okay, your statutory limit. So when you do the calculation, you will write cash received. Cash received is equal to total miles traveled into amount received from your employer per mile. From this, you have to make the statutory deduction. So the rule of not all the amount is taxable. Not all the amount is taxable. So it says the first 10,000 miles is deductible for 45 pence and the remaining miles is deductible at 25 pence. Okay. And if you have a positive figure, so this was the total amount you received from your employer. You don't have to pay tax on the entire amount. The first 10,000 into 45 pence can be deducted. Remaining miles into 25 pence can be deducted. The whatever is left, if it is a positive figure, it is excess of mileage allowance, which is taxable. And if it is negative, it is a deficit in mileage allowance and it is an allowable deduction. So the idea is, ഈ statutory limit വരെയുള്ള reimbursement non-taxable ആണ്. അതിന് മുകളിൽ നിങ്ങൾക്ക് എന്തെങ്കിലും കിട്ടിയിട്ടുണ്ടെങ്കിൽ അതിന് നിങ്ങൾ ടാക്സ് കൊടുക്കേണ്ടതായിട്ട് വരും. So travel cost, that is very, very important. Recently in an examination, travel cost is being tested and it is, if you want to refer, please refer to your study hub. They have clearly said the adjustments for so they have clearly said the adjustments for travel cost. So keep in mind, if an employee is traveling from their home to their permanent workplace, that cost, if it is reimbursed by the employer, it is a taxable benefit. That means any expenses spent for traveling from their home to their permanent workplace is non-reimbursable. And if they receive it as a reimbursement, it is taxable. But any travel costs they incur between their home to temporary workplace or to visit their client or between their temporary workplaces or between clients is a allowable amount. So whatever you have paid, it is deductible. So the rule is travel expenses incurred by employee. Let's say Aneetta, for example, Aneetta is an employee. So travel expenses incurred by Aneetta are tax deductible. Let's assume a situation where there is no reimbursement. Aneetta spent £100 traveling from her home to her permanent workplace on a daily basis. That £100 can be deducted from her salary if she is traveling to her home to permanent workplace and she is incurring the travel cost, but no one is reimbursing it. So any expenses, travel expenses, sorry, my bad. So it is other way around. Any travel expenses between home and temporary workplace is deductible. Okay, sorry. So any travel expenses between home and temporary workplace is deductible. So temporary workplace means a place where you work for less than 24 months. And just keep in mind, traveling expenses Aneetta incurs for traveling between her home and temporary workplace or between clients or to the client, back from the client. That expenses, if it is non-reimbursed, it is tax deductible. It has to be in the performance of the duty incurred by an employee to travel from their home to temporary workplace or travel between two temporary workplaces or between their client. The cost of regular commuting between the employee's home to their permanent workplace of employment is non-deductible. Let's say Aneetta incurred £10 each day to go from her home to her permanent workplace. She cannot deduct it from her salary. So what is temporary employment? Where the period is less than 24 months. That is a temporary employment. Payroll deduction scheme. I'll just go back to the main format. And once we discuss all the chapters, we'll move to section C questions, okay? So there is excess of mileage allowance, non-cash taxable benefits. Non-cash taxable benefits include car benefit, van benefit, living accommodation, beneficial loan, private use of asset, and other taxable benefit. Now, allowable deductions or deductible expenses which are not reimbursed. Employee contribution to OPC. So if Aneetta contributed any amount to her occupational pension scheme, that is deductible. Deficit in mileage allowance is deductible. Professional subscription fees paid by Aneetta is deductible. Charity donations under payroll deduction scheme is deductible. So all these amounts, if it is suffered by Aneetta, she can deduct it from her employment income. The rest of the things she received from her employer has to be added. Then there are certain expenses which Aneetta might have incurred, but she cannot deduct it or she don't have to add it to her employment income. For example, she made contribution to her PPC, non-deductible, indicate 0. She traveled from her home to her permanent workplace. She suffered the travel cost, non-deductible, indicate 0. Any employer contribution to OPC or PPC is non-taxable, indicate 0. Golf club membership paid by Aneetta to entertain the client, that is non-deductible, indicate 0. And you will get your total employment income. Let me quickly go to chapter 4, which is very, 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 very important. I cannot stress how important this chapter is for your section C calculation. So everyone who is doing self-study, make sure you learn. So make sure you learn chapter 4 thoroughly. Okay. So coming to chapter 4. It is taxable and exempt benefits. Living accommodation benefits. So there is a graph which I always take in the class. If you study this graph to a large extent, you can crack this area. So living accommodation benefit, which is a home provided or a house provided by the employer. If it is a job related accommodation, the house is a non-taxable benefit or an exempt benefit. If it is a non-job related accommodation, then you have to look in the question, is it owned by the employer or rented by the employer? If it is owned by the employer, the house is a taxable benefit and the taxable benefit is calculated as annual value or rateable value into time apportionment less any amount or rent paid by the employee. Then you have to check whether it is a luxury property. If it is a luxury property, that means if the cost of the property is more than 75,000, you have to add additional benefit charge. Additional benefit charges, cost of living accommodation minus 75,000 into students who are doing resit. Please keep in mind it is 2.25%. Okay, it was previously 2%. Now it is 2.25% into time apportionment as necessary. Finally, you need to check whether any running cost was paid by the employer. You have to add that. Provision of furniture, 20% is added and time apportioned. So you will get your total benefit on living accommodation. Now, if the property is rented by the employer, the taxable benefit is higher of annual value on rent paid by the employer, less any amount of rent paid by the employee. There is no additional benefit charge because it doesn't matter if it is a luxury property or not. It was rented by the employer. So you don't have to calculate additional benefit charge. Any running cost paid by the employer, it is the same calculation as what we did here. You will get your total taxable benefit. That brings us to the question, what is this job-related accommodation? Just keep in mind, job-related accommodation means one that is given for the purpose of proper performance of duty, better performance of duty, or for employee security reason. Either one of the three reasons will be specified in the examination, or they will very clearly say it is a job-related accommodation. So if they say it is a job-related accommodation, keep in mind the house is an exempt benefit, indicate 0. Or if any one of the condition is specified, keep in mind that is a job related accommodation. So it is an exempt benefit, indicate 0. Now moving on to the next one. Private use of asset, again very commonly tested in section A, which is if an employee is given an asset for private use by an employer, you will have to calculate the usage benefit, which is higher of 20% of the market value when it was provided to the employee, and if it was rented by the employer, the rent paid by the employer. Normally, it is rent, it is owned by the employer, so you can avoid this portion. It is 20% of the market value when first provided. Certain circumstances, the employee will be given the asset for free or as a gift. You will have to calculate the acquisition benefit there. In that circumstance, acquisition benefit is higher of the current market value at the time when the employee purchased minus any price paid by the employee. So in certain cases, the employer will give the asset free to the employee. In that situation, you just take the market value. There is no price paid by the employee. Certain cases, the employee will purchase this asset from the employer at a lower than market value. So in that instance, you will have to deduct the price paid by the employee. Then market value when first purchased less any amount already taxed minus price paid by the employee, you will get your, so you'll have to take the higher value as your acquisition benefit. Car benefit, it's a very straightforward calculation. If it is an electric car, zero CO2 emission, 2% is the percentage of benefit, taxable benefit. You can use the electric range for 21 to 50 grams per kilometer carbon emission. And if the carbon emission is between 151 to 54, it is 15%. And if it is exactly 55 grams, it is 16%. And don't worry, these rates will be given in the tax table for you. And if the percentage is above 16, as previously, there will be an increase in the rate. So that is 16% plus the CO2 emission minus 55 divided by 5 will be added to 16%. And keep in mind, if it is a diesel car, there is a 4% surcharge if RD2 standard is not met. But always keep in mind the maximum percentage is 37. If you get an answer above 37, please round down to 37. Now I'll show you how to do the calculation of car benefit. You will directly take the list price. Always ignore the discounted price. From that, you will deduct any capital contribution made, which will be very clearly said in the question. The employee paid for the cost of the car, not the running cost, but the actual purchase cost of the car. So capital contribution can be deducted, but a maximum of 5,000. This is where most students may go wrong. They deduct the entire amount of capital contribution. Maximum 5,000 can be deducted. Then from the net amount, you take the percentage. The percentage is based on CO2 emission into time apportionment. To this, you have to add any running cost paid by, you have to deduct any running cost paid by the employee. Any running cost paid by the employer is indicated 0. If driver is provided, you will have to add that as well to get your taxable car benefit. Fuel benefit, this will be directly given in your examination tax and allowances table. Beneficial loan, very commonly seen for section C. The two methods, it is lower of average method and strict method, which I'll explain to you with the example. Just keep one thing in mind. If your loan amount is less than 10,000, you don't have to calculate a beneficial loan taxable amount. And there is a list of all the exempt benefits. I'll just scroll down very slow. If you want, you can take a screenshot of this as well. So exempt benefits means these are the benefits that you receive from your employer for which you don't have to pay tax. Moving to chapter 5, pension. There are two types of pension. There is occupational pension and personal pension scheme. Occupational pension, only an employee can join the scheme and it is directly, if employee contributes to their OPC, it is deducted from their salary. Personal pension scheme, anyone can join the scheme. Keep in mind, always gross up the amount. It is used for band extension and adjusted net income computation. UK relevant earnings means your employment income plus trading income plus income from FHL. You're not supposed to include investment income and property income. Keep in mind, there is something known as annual allowance. So you can contribute any amount to any number of pension schemes during a tax year. But after a point, the contribution becomes taxable. So that point is annual allowance. So up to the amount of annual allowance, you can make a tax-free contribution to the scheme, and any contribution above that becomes taxable. So this annual allowance is normally 40,000, but it is based on a figure known as adjusted income. Adjusted income is basically your net income, total net income plus individual employee contribution to OPC, add employer contribution to OPC and PPC. So you take your adjusted income. If your adjusted income is less than 240,000, then you are eligible for this full 40,000 as your annual allowance. If your adjusted net income is between 240 to 3,12,000, then you will have a reduced annual allowance or a tapered annual allowance. And if your adjusted net income is exactly 3,12,000 or above, your annual allowance is fixed of 4,000. And remember, when you do the band extension, after studying pension, when you do the band extension, it is lower of A and B, which is gross amount of personal pension contribution, and higher of 3,600 UK relevant earnings. Let me quickly go to property income. There are 4 types of property income. Normally tested for examination is property business income, rent-a-room relief, and premium on lease. Property business income, this is a normal format. The one thing that you have to keep in mind is there is something known as replacement of domestic relief. So already there was this applies to equipments, appliances, kitchenwares, sofas, and furnitures. So already when you let out a property, you already had an asset in that particular property, and you are replacing it with the same asset, same model of an asset. The purchase cost of the new one minus the sale proceeds of the old one. That is the replacement of domestic relief. Now, if a situation you did not have an asset and you're purchasing it for the first time, you cannot deduct it from your rent income. A third situation is where you purchased an asset which already existed in the property, but it was a different model. So in that situation, you will have to take the value of the market value of the old model minus the scrap value from the old asset. We have questions on property income, so I'll discuss the rest during the time. I have elaborated the list. Trading income, when you do the trading income computation, just keep in mind an individual has calculated their trading income in their SOPL using accrual basis. You will have to convert that trading income into tax adjusted trading profit. So certain non-deductible expenditures have to be added back. Certain deductible expenditures have to be indicated 0. Certain expenses which are not deducted will have to be deducted. For example, capital allowance. So this chapter is all about capital allowance. So when you do a capital allowance computation, first is segregation of each expenditures into the pool. Main pool, which contains plant and machinery and cars with CO2 emission between 1 and 50 grams per kilometer, and second-hand electric car. The WD is 18%. You have to time a portion on the basis of SOPL period. Special rate pool, this contains integral features of building, long life asset, and cars with CO2 emission more than 50 grams per kilometer, first and second hand car. The WD is 6% and time apportion. Then you have how to calculate WDV. You take the opening balance plus you take all the additions minus the disposals. When you take the disposal, it is lower of purchase cost and the sale proceeds. You will get a nameless balance. In the class, I told you there is a nameless balance. And on that nameless balance, you will have to apply WDV. If it is a main pool item, 18%. If it is a special pool item, 6%. Now keep in mind AIA. For main pool and special pool items, there is something known as AIA. For 12 months, it is 1 million. This is only eligible for plant and machinery. Anything except car and cycle is eligible for AIA. So what happens is first 1 million of the expenditure will be written off in your capital allowance column. Then you have FIA. FIA is available for new electric car. The 100% amount is written off in your capital allowance. Small pool balance. So if the nameless balance is less than or equal to 1,000 for 12 months in the main pool or the special pool, that is a small pool balance, and the entire amount will be transferred to the capital allowance. You don't have to calculate a WDA. Balancing charge. If ever your capital allowance, if ever your nameless balance is negative, we call it as balancing charge. And that negative figure as such is transferred to your capital allowance column as a charge. Now, balancing allowances, there are three situations where you can write balancing allowances. Number one. So there are three situations of balancing allowances. If the nameless balance is positive. So if the nameless balance is positive. If it's a short life asset sold within 8 years, or if it is a privately used asset sold, or if it is a final year of trade. In that circumstances, if the nameless balance is positive, we call it as balancing allowance, and you transfer the entire amount to your capital allowance column. For individual's case, private use of asset has to be shown in a separate column. The WDV depends on whether it was a main pool item or a short special pool item. And your capital allowance will be restricted to the business usage. Short life asset, in the question, you have to look out for the word election or depool election. If they made an election or a depool election, that is a short life asset that has to be separately shown in a column. And then WDV should be applied based on what category it belongs to. If it is sold within 8 years, you will have to calculate. So if it is sold within 8 years, you will have to calculate. If it is disposed within 8 years, if the nameless balance is positive, it is a balancing allowance and transfer it to your capital allowance column. If it is not sold within 8 years, whatever remaining balance, put it in the respective column. From the short life asset column, you transfer it to either main pool or the special pool. SBA, which is very, very important. This is for structure and buildings. It is a straight line 3%. From the usage date to the SOPL end date. Just keep in mind, SBA, leveling cost of land is eligible for SBA, but the cost of purchase of land is not eligible for SBA. Planning permission, solicitor fees, stamp fees are not eligible for SBA as well. Now, the best part about change in the syllabus is that Chapter 9, which was ideally accessible income, has been completely eliminated from your syllabus. That means your chapter trading income has been much simplified. Let me just remind you that the trading income computation for an individual, they can claim a current year relief against their general income. They can carry back to the previous 12 months and set off against their general income, and they can carry forward and set off against their future trade profit. Now, when you set off against your general income, you just have to keep in mind, if your net income, if your general income is less than 12,570, it is better not to set off during that year for beneficial way. Now, if it says as early as possible, do the set off. Next one is the next one is opening relief. The first 4 years trade loss is set off against previous 3 years general income. Whenever you set off against general income, just keep in mind there is a limit of maximum amount you can set off, which is higher of 50,000 and 25% of adjusted total income, which is your total income plus total income minus gross amount of PPC. And there is no difficulty for terminal loss as well. The final 12 months trade loss is called terminal loss. It is set off against previous 3 years trade profit on a LIFO basis. Since accessible income chapter is eliminated, terminal loss is a very easy calculation. You just need to take the last 12 months of your last 12 months loss. And finally, partnership. Any income received from partnership is a non-savings income, be it partnership salary, partnership interest on capital, or profit share. It is a non-savings income. Again, since accessible income chapter was eliminated, partnership is also very simplified. And the next chapter is NIC. So students, referring to NIC rates have completely changed, but the rule for employment allowance is still the same, and mileage allowances and those calculations remain the same. The only change is for the rate. So what you can do is you can refer to your latest material and your tax allowances table where the latest rate for NICs will be provided. You can refer to that. Okay. Calculation remains the same except the rate has changed. Rest of the topics are same for NIC. So I'm going to move to some question practice for income tax section C. So I'll start off with the question. This is from your BPP. You have the same question in your Kaplan as well. So today we'll be doing the easy ones and tomorrow we'll be doing with the difficult ones. Okay. So first and foremostly, we'll start with question number 97 from your BPP, your latest BPP edition. Calculate Alfred's revised tax adjusted trading profit or loss for the 7-month ended 31st March 2024. So they are asking for tax adjusted trading profit computation. Alfred and Amaya are a married couple. Alfred commenced trading as a sole trader on 1st September 2023, which is our tax year, 23-24 tax year. He prepared his first set of 7-month period ended. So from September till 31st March, September, October, November, December, January, February, March. For 7 months, his draft tax adjusted trade profit before capital allowance was 63,000. So his profit figure before deducting capital allowance was 63,000. And the draft tax adjusted profit is before adjusting the following items as well. So the following items are not yet included in that 63,000. So you need to check whether you need to add this to the 63,000, deduct it from the 63,000, or it is non-deductible or indicate zero. 5,000 incurred during January and February on a marketing campaign for his business. He started the business on 1st September 2023. This is an expenditure before he started his trade. Yes or no? He started on 1st September 2023. He incurred the expenditures in January and February 2023. What happens is this is what we call as pre-trading expenditure incurred before the commencement of trade. So if it is a pre-trading expenditure prior to 7 years before the start of the trade, that can be deducted from your first SOPL. So this 5,000 can be deducted from the 63,000. Many times in this question, students have a doubt. We usually do E indicates 0 for allowable expenses. Why are you deducting it here? See guys. If a figure is already finally computed and you are changing that entirely, then you will have to add back and deduct and indicate 0 there. Here, 63,000 does not contain any of the following adjustments. So what you're going to do here is you're going to check whether the adjustment is required or not, and accordingly you will make the deductions. And if a deduction is not required, you will put a 0 there. So this is a deductible expenditure. I can deduct it from 63,000. Next, a premium of 30,000 to acquire a 10-year lease on a workshop. Keep in mind, for you, it is premium paid. So you will have to calculate the amount of the tax deductible amount on premium paid. Then cost of a golf day for a group of largest client. Keep in mind, golf club membership for client entertainment is non-deductible, indicate 0. If it is already deducted, add back. If it is not deducted, indicate 0. Expenditure of 1,16,000 for plant and machinery, you can claim capital allowance AIA there. Purchase of a car, CO2 emissions 24 grams per kilometer. It's a main pool item. It is used by Alfred's employee. So you can claim capital allowance at 18% in the main pool, but don't forget to time apportion 7/12. So how about let's do a computation. The computation of revised tax adjusted trade profit for the 7-month ended 31st March 2024. Starting off with the draft tax adjusted trade profit of 63,000. And keep in mind, you can deduct pre-trading advertisement expenditure of 5,000 from this. Then premium. So less deductible amount on premium paid. You'll have to do the calculation for that. So in order to do that calculation, first we have to calculate the taxable premium amount. And from that, you have to divide it by the number of years into 7/12. So we'll take premium received. Premium received is equal to received alla premium paid ana. For this person, it is premium paid, but to do the calculation, premium received is equal to 30,000. From that 30,000, we'll have to do a calculation which is equal to 30,000 into n minus 1. N is 10 years. So 10 minus 1 into 2%. Into 2%, which is equal to 30,000 into 10 minus 1 into 2%. So you will get your taxable amount, not your taxable amount, for the landlord. And from this taxable amount, you will have to calculate the tax deductible amount, which is equal to 24,600 divided by, it is a 10-year lease, into 7 divided by 12. 1435. And then there is golf day cost. So this amount is equal to 1435. Then there is a golf. It is non-deductible, indicate 0. And finally, there is capital allowance. So you have capital allowance on 2 items here. So I'll do a separate calculation for capital allowance. So computation of capital allowance for the 7-month ended. Seven-month ended 31st March 2024. You'll start off with, you need a column, blank column, and then you need a main pool and a capital allowance column. So you'll start off with the, was there any TWDB brought forward? No, it's a new business, so there is no TWDB brought forward. So additions qualifying AIA, you have a plant and machinery. So the amount is 1,16,000, and this entire 1,16,000 can be written off as AIA. So this entire amount can be written off, and immediately update your capital allowance column as well. Then additions not qualifying AIA. Additions not qualifying AIA, which includes car. It was actually a main pool item because the CO2 emission was 24 grams per kilometer. It is 24,000. So you can calculate your WDV on this 24,000. So less WDV will be at 18% for 7 months. Please keep that in mind. So that is equal to this amount into 18% into 7 divided by 12. And immediately update your capital allowance column as well. So after making this deduction, you will calculate your maximum capital allowance. That is your maximum capital allowance. One 520. And finally, you will get your tax adjusted trade profit. And remember, students, the time bound calculation. How do you take the time here? You have a loss of 61,955. Tax adjusted trade loss. Now, students, this is a time-bound calculation. So how do you apportion the time? Always make sure, go to the question and see what is the number of marks for this. So this is a 6-mark question. So if it is a 6-mark question, that means for per mark, you can spend 1.8 minutes per mark. Therefore, if it's a 6-mark question, it is 6 into 1.8. Which is equal to 10.8. So that is the maximum time you can spend on this question. We have spent a little longer than that, but make sure when you do your preparation, you spend only 1.8 minutes per mark. We'll move to the next one, which is calculate the income tax payable by AMEA for the tax year 23-24. So we are moving to the case of AMEA. AMEA is employed by Argol Limited and her remuneration package comprises an annual salary of 80,000. So salary on 1st January 2024, that is towards the last 3 months, employer provide AMEA with a petrol-powered company car benefit. List price is 25,000. She received a discount and only paid 23,500. Please keep in mind, ignore your discount price. You're only supposed to take the list price. The car has a CO2 emission of 52 grams per kilometer. Therefore, the percentage will be 15 percentage. Argol did not provide any fuel for AMEA's private use. So you can calculate your car benefit using the information. There was a living accommodation benefit, but it qualified as a job-related accommodation. If it is a job-related accommodation, that means it is an exempt benefit, indicate 0. The annual value is irrelevant. Now, Argol deducted income tax under pay of 9240 from AMEA's salary. Pay is deducted because the question was to calculate income tax payable. So the pay amount is given to you, it is 19,240. AMEA has let out her own house unfurnished at a rent of 1,200 per month. Keep in mind, for an individual, property income calculation is by default cash basis. AMEA received 13 months rent during the tax year. So I know if you are using accrual basis, we'll only take 12 months rent. But when you're using cash basis, you have to take the 13 months rent. So 1,200 into 13 months. AMEA has a mortgage which she took out to acquire the house which she let out. She made the mortgage payment of 6,000 including an interest of 2,600. Mortgage payment is non-deductible. Interest is also non-deductible. But 20% of the interest can be deducted from your income tax liability. This is if you purchase a residential property for letting out and took a loan for that and paid interest. 20% of that interest can be deducted from your income tax liability. AMEA paid an insurance premium of 800 during 31st December 2023. That is our tax year. On 1st December 2022. So that is not our tax year. That is the previous tax year. And also again on 1st December 2023, she paid a premium of 1250, which relates to the next tax year, but that is okay. The payment date is relevant. So you're using cash basis, just check which is the payment date. So you can calculate your income tax payable by AMEA. Starting off with computation of employment income. So we'll take the gross salary. So gross salary of Ameya is 80,000. To this, you have to add car benefit. So coming to the car benefit aspect, it is very clearly said in the question that it is the list price is 25,000. So don't take the discounted price into, there is no capital contribution here. 52 grams per kilometer is the CO2 emission. That means the rate of percentage is 15% into, it was only given for 3 months towards the end of the tax year. So into 3 divided by 12. So that is equal to 25,000 into 15% into 3 divided by 12. And get rid of any decimals in your tax examination. We don't want any decimals. Then you have job related accommodation. Job related accommodation is an exempt benefit, indicates 0. And finally, she has property income. Can add her property income. So that is a working note, property income. When you do her property income computation, you should always start with the rent received. The rent received is equal to 1,200 into 13 months. It's cash basis. So irrespective of the number of months, you have to take whatever cash you received during that tax year. From that, you have to deduct insurance paid on 1st December 2023, which was 1,250. The mortgage interest and the mortgage payment is non-deductible. The mortgage interest 20% can be deducted from the income tax liability computation. So the taxable amount is equal to 14,350. So that was about property income. So you calculated your, this is your total / net income. From this, you have to deduct personal allowance. Your adjusted net income is less than 12,570. So you are eligible for, so your adjusted net income is less than 1 lakh. So you are eligible for full 12,570. So therefore, your taxable income is equal to 82,718. Then next thing is, once you get your taxable income, it is computation of income tax liability. Computation of income tax liability. When you do the income tax liability, all of this is non-savings income, okay? So when you take the non-savings income, he is a higher rate taxpayer. But always keep in mind the first 37,700 is taxed at basic rate. So this is non-savings income. And just taxed at basic rate. So up to 37,700, it will be taxed at 20%. And anything above that will be taxed at the higher rate. So 82,718 minus 37,700 will be taxed at 40%. From this, you have to make an interest cost relief, which is equal to the amount of interest that you've paid on the property, which is 2,600 into 20%. And finally, you will get your total income tax liability. And from this income tax liability, you will have to deduct payee, which is directly given in the question. Payee figure is 19,240. So you will get your tax payable. And don't forget to get rid of any decimals in your calculation as well. So this is your tax payable. Decimals are not allowed in your examination, so make sure you get rid of any decimals prior to finalizing your answer. So that was question Amaya. Next one is let's do question John, which is question number 98, John. So this question gives you a proper understanding of the adjustment for pension. Okay, so the requirement of the question is to calculate the income tax liability for the tax year 23-24 of John. And 3 advantages of rental property qualifying as FHL. So what are the advantages if the property is an FHL? So FHL, income received from FHL property qualifies as a UK relevant earnings. So that means you will get a tax relief there. When you sell an FHL property, then it will be eligible for BADR relief, ROR, and gift relief as well. Also, any furnitures purchased for the property can be deducted from the property income computation itself. You can claim a 100% reduction rather than a replacement of domestic relief. So these are some of the advantages of having rental property qualifying as an FHL. Now, so that is a 3-mark question. Just write 3 points, complete sentences. Don't write bullet points. Complete sentence, 3 sentences. That's it. You'll get your marks. Computation of income tax liability. Let's do that. John is employed by Surf PLC. The following information is available for the tax year 23-24. During the tax year 23-24, John was promoted and paid a gross remuneration of 3,28,318. So that is his gross remuneration for the current tax year. In each of the tax year 2021, 21, 22, 22, 23, his adjusted income was below 240,000. Why did they very clearly said that? Because in the previous 3 tax years, since his adjusted income was below 240,000, he was eligible for an annual allowance of 40,000. During the tax year 23-24, John contributed 18,000 to his OPC, which is deductible from his salary. Company contributed 12,000 on their behalf. This is exempt benefit indicates 0. Both John and Surf have made exactly the same contribution for the past 5 years. During 2020, Surf PLC provided John with a loan which was used to purchase a yacht. So that is related to beneficial loan. So we have to check the amount of the loan, which was 84,000. The amount of loan outstanding at 6th April, the start of the tax year was 84,000. John repaid 12,000 on 31st July and then 12,000 on 31st December. That means by the end of the tax year, only 60,000 was remaining. He paid loan interest of 90 to Surf. Taxable benefit is calculated using average method. So they're asking you to use average method. During the tax year 23-24, John made a personal pension contribution up to the maximum amount of annual allowance. So they did not give you the amount of personal pension contribution, but they told you it is the remaining limit of your annual allowance. So first we need to find out what is the remaining limit of your annual allowance for the current tax year. Only once you get your personal pension contribution, you can take it further for your income tax liability because there is band extension. John owns a holiday cottage which is let out as FHL, although the letting does not qualify under FHL rules. So it's a normal property business income. The property business has a profit of 14,855 before taking into account 1,875 paid for a letting agent, that is deductible. John paid a loan interest of 7,500 to purchase this property. Keep in mind, if it is an FHL, the entire interest paid on the loan is deductible. But if it is a property business income, it is not deductible. Only 20% of the interest is deductible. So let's do the computation. Start off with computation of taxable income. Okay, so there is only non-savings income for John. Starting off with employment income, we can do the computation in the main format itself. So he has a salary, gross remuneration of 328,380. From that, you can deduct John's contribution to OPC. Try to link it to the scenario. Try to bring in the name of the employee once in a while. 18,000. Make sure self contribution to OPC is indicated with a 0. It is an exempt benefit. You have to indicate 0. Beneficial loan. Add beneficial loan. Beneficial loan. So we'll have to do a computation using average method. So which is equal to the opening balance. The opening balance at the start of the tax year was 84,000 plus the closing balance. So out of 84,000, there were 2 repayments. So minus 12,000 and again there was a repayment of 12,000. So that is the closing balance. Divided by 2 into 2.25% less interest paid. Interest paid of 90. So you'll finally get your taxable amount. So when you do the computation is equal to 84,000 1530. Then you can add the property income as well. So coming to the property income computation. It is not an FHL, does not qualify as an FHL. So the property profit is 14,855. Minus the letting agent fees is 1875. Now, if it was an FHL, the interest paid of 7,500 can be deducted, but it is not an FHL, so you cannot deduct 7,500. So 14,855 minus 1875. That is your total / general income. Anyway, your net income has exceeded the limit. So you're not eligible for any personal allowance. I told you at the start of the class, if your personal allowance is 0, you have to write yes, since NI above 125, 140, and then indicate 0 there. So that is your taxable income. Now, we're not done with the calculation because the calculation was true for income tax liability. So we have to continue. So once you continue with the income tax liability computation, we have to see what is the amount of personal pension contribution, because only once you get your amount of personal pension contribution, we can do the band extension. So the idea was they did not give you the amount of personal pension contribution, but they told you it is a maximum contribution with the remaining annual allowance. So let us find out what is the annual allowance for 23-24 tax year. Okay, so the annual allowance for 23-24 tax year is, obviously the adjusted income is greater than 3,12,000. Therefore, the AA is equal to 4,000. Along with this 4,000, you can add 3 years carry forward unused AA for the previous 3 years. That means you can carry forward from 2021, 21-22 and 22-23. So for that, we have to do a small analysis here. So for all the tax years from 2021, 21-22, 22-23, we have to write down what was the available AA. In all these years, your adjusted income was below 2,40,000, which was given in the question. So your available AA is 40,000. Now, out of which you have utilized, in all these years, there was a personal pension, there was a OPC contribution from your side and your employer side. So in all these years, this was the amount of utilized. So your balance AA in all these years were 10,000. This 10,000 can be carried forward. So the AA available for 23-24 is equal to the 4,000 of the current year plus the 3 years unused AA, that is 10,000 plus 10,000 plus 10,000. So which is equal to 34,000. Out of this 34,000 already utilized in 23-24 is the contribution of, we have already utilized 18,000 OPC from employee and 12,000 OPC from the employer. That means out of this 34,000, you have already utilized 30,000. So your remaining limit is 4,000. And they told you in the question, whatever is your remaining amount, that is the contribution you have made to PPC. So this is the PPC contribution. This is the gross PPC contribution. So you need to do a band extension with 4,000 in your calculation. So when you do a band extension with 4,000, computation of income tax liability for non-savings income. Start off with basic. Basic, which is equal to 37,700 plus 4,000. Into 20%. 41,700 into 20%. Then you can add your higher limit. Again, your higher limit will also increase 125, 140 plus 4,000 minus 41,700. That is up to 87 for 40. You can apply 40%. So up to 87 for 40, you will apply 40%. And above that, you will apply additional rate. So additional rate is equal to additional rate is equal to 324828 minus already you have taxed up to 1,000. This is your total tax liability. And please get rid of any decimals as well. Okay, there is one final aspect which we missed out. There was an interest cost. There was an interest cost in the question. The property income. John paid a loan interest of 7,500 in the year in respect of a loan to buy this property. So, therefore, since it is a residential property, the interest on loan to purchase the property to let out, you can calculate an interest relief of 7,500 into 20%. $129,876. So that was a pretty good question which tests your knowledge of pension as well. So I hope this was useful for you. And we will continue the revision tomorrow with much more questions as well. So I'll see you guys tomorrow. Take care.